Think your morning latte is just a caffeine fix? Think again. Behind that $7 cup of joe, a brutal corporate war is raging. While the world was sleeping, the coffee landscape shifted. Today, we're peeling back the curtain on the 2025 coffee sector. We're talking about the giants struggling to stay relevant and the newcomers who are literally stealing the sugar out of their bowls. Welcome to the strategic divergence of 2025. If you look at the market right now, it's not just one big happy family. It's a three-way split. You've got Starbucks, the aging king, trying to figure out how to be efficient without losing its soul. You've got Dutch Bros, the high-speed rocket ship that doesn't know how to slow down. And then there's BlackRock, the new kid on the block, testing the waters. It's efficiency versus scale versus raw expansion. Grab your mugs, this is going to get caffeinated. Let's start with the 800-pound gorilla, Starbucks. They brought in over $37 billion this year. To put that in perspective, that's enough to buy every single person in New York City a brand new Tesla and still have change for floor mats. They have 40,000 stores. They are everywhere. But here's the problem. When you're already everywhere, where else is there to go? They've hit the ceiling, and the growth engine is starting to cough. Now here's the crater in their pocket. While Starbucks was busy raising prices to make their numbers look good, something terrifying happened. People stopped showing up. Transactions in North America dropped by 4%. That sounds small, right? Wrong. That's millions of people choosing to walk away. It turns out, you can only charge so much for a third space before people decide their own kitchen is just fine. This is a brand loyalty crisis in real time. Let's look at the scoreboard. SBUX is the giant, sure. But look at Dutch Bros. Their revenue grew nearly 28%. While the giant is growing at a snail's pace of 3%, the challenger is sprinting. And look at the same-store sales, the true test of a business's health. Starbucks is in the negatives, while BlackRock is seeing a double-digit surge. It's like a race between a cruise ship and two jet skis. The jet skis are winning on agility. In the world of consulting, we say, net profit is an opinion, but cash is a fact. Starbucks and Dutch Bros still have plenty of lunch money in their pockets. Their cash flow is healthy. But look at BlackRock. They posted a loss. Why? Because being the new kid is expensive. IPO costs and restructuring ate their lunch. The core business is making money, but the entry fee to the big leagues is steep. This is the flex slide. Pricing power is the ability to raise prices without your customers throwing a tantrum. Starbucks raised prices and lost customers. That's a fail. Dutch Bros raised prices, and more people showed up. That's a flex. It means people aren't just buying coffee, they're buying the vibe. And they're willing to pay a premium for it. Here's the secret sauce. Dutch Bros isn't just a coffee shop. It's a secret energy drink empire. A full quarter of their sales comes from their Rebel energy drinks. This is genius. Why? Because coffee beans are volatile. One bad harvest in Brazil, and your margins are toasted. But energy drinks? That's just syrup and carbonation. High margins, Gen Z appeal, and zero quote 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 quote. They've basically built a moat out of caffeine and neon colors. Let's talk about shelf life. Starbucks turns its inventory about 6 times a year. That's okay. But Dutch Bros? They turn it 26 times. Their stuff doesn't sit in a warehouse gathering dust. It flies off the shelves. This kind of supply chain velocity is what allows them to open new stores like crazy without needing a massive bloated back end. They are lean, mean, and very fast. Where is the money going? Starbucks is betting on robots, AI, and automated systems to try and save on labor. Dutch Bros is building huge roasting plants to feed their expansion. And BlackRock? They're building pods, little drive-through boxes that cost less than $1 million to build and start printing money almost immediately. It's 3 very different bets on the future. Now, a warning for the investors. Every party has a hangover. Look at BlackRock's debt. Their interest coverage is almost 0. That means they are barely making enough to pay the bank the interest on their loans. In a world of high interest rates, this is a tightrope walk without a net. One bad quarter and the bank might come knocking. And we can't ignore the dragon in the room. China. Starbucks has over 8,600 stores there, but they've realized they can't do it alone. They're pivoting to a partnership model, basically saying, you know the local market better, let's share the risk. It's a smart move to survive the local competition. And yes, we're counting the whole region here, because in business, you follow the people and the cups. So what's the play? If you're the big guy, stop worrying about more stores and start worrying about making the ones you have smarter. Use that AI. If you're the challenger, keep pushing the energy drinks. And if you're the small guy, for the love of coffee, pay down your debt. The expansion at any cost era is officially dead. Now it's about survival of the most efficient. As we look toward 2026, the winners won't be the ones with the most signs on the street. They'll be the ones with the fastest supply chains, the highest quality profits, and the ability to innovate beyond just the bean. The coffee war is just getting started, and the stakes have never been higher. That's the deep dive for today. If you want the full, data-heavy research reports that the pros use, head over to HDINResearch.com or drop us an email at sales@HDINResearch.com. Don't forget to like, subscribe, and tell us in the comments, are you Team Starbucks or Team Dutch Bros? I'm out. Stay caffeinated.